The U.S. economy is supposed to be back on track. Jobs are growing. Inflation is cooling. Markets look calm again. And yet, millions of Americans feel more anxious about money than ever. Every grocery run feels heavier. Every bill raises a quiet fear. So here's the real question. If the economy is doing fine, why does opening your wallet still feel like a risk? Tonight, we're unpacking the gap between what the numbers say and what people actually feel. To understand why the numbers in the feelings don't match, we need to slow down and ask a basic question. What does a good economy actually measure? Most headlines point to the same indicators. GDP is growing. Unemployment is low. The stock market has recovered from past shocks. On paper, that looks like success. Gross Domestic Product, or GDP, measures how much economic activity is happening overall. It tells us the economy is producing more goods and services than before. But GDP doesn't tell us who benefits from that growth or how evenly it's shared. An economy can grow while most households feel stuck. Both things can be true at the same time. When GDP rises, a large share of that growth often comes from corporate profits, financial markets, and high-income sectors. If those gains are concentrated at the top, the average household may see very little change or none at all. So the chart goes up, but the kitchen table conversation stays the same. The unemployment rate tells a similar story. A low unemployment number sounds reassuring. It suggests that most people who want a job can find one, but it doesn't say what kind of job that is. It doesn't tell us whether the work is full-time or part-time. It doesn't tell us whether the pay keeps up with rent, food, and healthcare. And it doesn't tell us how stable that job really is. Many new jobs are in lower-wage service sectors. Others are contract-based, gig-based, or offer limited benefits. On paper, employment rises. In real life, income security does not necessarily follow. For many households, having a job no longer means having financial breathing room. Then there's the stock market, often treated as a shortcut for economic health. When markets rise, confidence rises with them. But stock ownership in the U.S. is heavily skewed toward higher-income households. Large portions of the population either own no stocks at all or have only small exposure through retirement accounts. So when markets rebound, the psychological signal is strong, but the direct financial impact is limited for many families. It looks like recovery. It feels like distance. This is where the idea of averages becomes misleading. Economic data often relies on national averages, average income, average inflation, average spending power. But no one lives in the average. Households experience prices and income changes very differently depending on where they live, what they earn, and what they spend most of their money on. If rent, insurance, groceries, and utilities rise faster than wages, even modestly, the pressure builds quietly but steadily. Not enough to make headlines, enough to make people uneasy. And that unease is rational. When people say they feel worse off, they are not contradicting the data. They are responding to a different layer of reality, one the headline indicators don't fully capture. There's also a timing problem. Macroeconomic indicators often improve before households feel relief. Companies stabilize. Markets anticipate recovery. Policy effects show up in statistics, but household balance sheets recover more slowly. Savings depleted during inflationary periods don't refill overnight. Debt accumulated during high-cost months doesn't disappear when inflation cools. So even when conditions stop getting worse, they don't immediately feel better. That gap between stabilization and relief is where anxiety lives. Another important distinction is between levels and changes. Inflation may be slowing, meaning prices are rising more slowly, but prices are still high compared to a few years ago. Slower increases don't reverse past increases. For households, the reference point is memory, not trend lines. People don't ask, are prices rising less fast? They ask, why does everything still cost so much? From their perspective, the damage is already done.
Put all of this together and a clearer picture emerges. The economy can look healthy when measured in aggregate. It can be stable by institutional standards. It can even be improving by technical definitions. And yet, for households navigating monthly expenses, the experience can still feel fragile. This is not a contradiction. It's a mismatch of lenses. Macroeconomic indicators describe the system. Household sentiment reflects lived reality. When those two drift apart, trust erodes. People stop believing what they hear in headlines, not because the data is fake, but because it doesn't speak to their situation. And once that disconnect sets in, anxiety becomes persistent. Because if the economy is supposedly doing well and you still feel financially exposed, the worry isn't just about money, it's about whether the system is actually working for you at all. And that brings us to the next layer of this story, not just what the numbers measure, but how long-term costs and expectations have quietly shifted underneath American households. If macroeconomic data feels abstract, the cost of living is not. You don't read it in reports, you feel it at the checkout line. This is where the gap between inflation cooling and household anxiety becomes impossible to ignore. Because while inflation rates may be coming down, prices are not going back. Housing is the clearest example. For many households, rent or mortgage payments are the single largest monthly expense. Over the past few years, housing costs jumped sharply, and once those prices reset higher, they rarely reverse. Even when rent increases slow, the new baseline remains. A family paying hundreds more each month doesn't feel relief just because the increase stopped. The damage is already baked into the budget. Food tells a similar story. Grocery prices may not be rising as fast as before, but anyone who shops regularly knows this. The total bill still feels heavier than it used to. Staples cost more. Portions feel smaller. Discounts don't stretch as far. Food isn't optional spending. There's no easy substitute. So households adapt, not by feeling safer, but by quietly cutting elsewhere. Healthcare adds another layer of pressure. Insurance premiums, deductibles, and out-of-pocket costs continue to climb. Even for families with coverage, medical expenses remain unpredictable. One unexpected bill can wipe out months of careful budgeting. And the fear isn't just about today's costs.
It's about the next emergency. Education and childcare intensify the strain. For families with children, these costs don't fluctuate month to month. They escalate over time. Tuition, fees, childcare, extracurriculars. Each decision feels like a trade-off between present stability and future opportunity. Cutting back doesn't feel responsible, but paying more doesn't feel sustainable either. Then there's insurance, auto, home, health. Premiums rise quietly, often without dramatic headlines, but over a year they compound. Another automatic payment, another slice taken before money even reaches a checking account. When people say their money doesn't go as far anymore, this is what they mean. And this brings us to the key misunderstanding. Inflation slowing does not mean life is getting cheaper. It simply means prices are rising more slowly than before. From a policy standpoint, that's success. From a household standpoint, it's irrelevant. Because the question people are asking isn't, is inflation lower than last year? It's, why is my standard of living harder to maintain? This is where psychological lag sets in. During periods of high inflation, households make adjustments. They dip into savings. They carry more credit card balances. They delay repairs, vacations, long-term plans. Those decisions don't reset when inflation eases. Savings that were drained don't refill automatically. Debt accumulated under pressure doesn't vanish when conditions stabilize. So, even if income rises on paper, the recovery feels incomplete. Many middle-income families are earning more than they did a few years ago, nominally. But after higher fixed costs, higher insurance, higher food bills, and lingering debt, the margin for error is thinner than ever. That thin margin is what creates constant tension. It's not that people expect things to get dramatically worse, it's that they don't feel protected if they do. And that sense of exposure matters. When households feel financially fragile, they behave defensively. They postpone big decisions, they avoid risks, they hesitate to believe good news. Not because they're pessimistic, but because experience has taught them caution. There's also a deeper shift happening beneath the numbers. For many Americans, the cost structure of life has permanently changed. Essentials take up a larger share of income than they used to. That leaves less room for saving, investing, or absorbing shocks. The lifestyle didn't inflate, the obligations did. And once that happens, anxiety becomes structural. Even small disruptions feel bigger when there's no buffer. Even positive news feels distant when it doesn't change daily math. This is why cost of living pressure cuts through economic optimism so effectively. You can debate GDP, you can question market signals, but you can't argue with a bank balance. And that leads to the central twist of this moment. The problem isn't that prices are still rising fast, it's that they rose too high and stayed there. Households aren't reacting to current inflation, they're living with its aftermath. And until income growth, affordability, and security realign at the household level, confidence won't simply return because a chart looks better. Which raises the next, more uncomfortable question. If this pressure is persistent, if it's built into the structure of everyday life, what does that mean for how households plan, spend, and think about the future? That's the layer we need to examine next. By this point, the pattern should be clear. The anxiety many households feel isn't just about prices or paychecks, it's about trust and how badly that trust has been worn down. Because for millions of people, the last few years didn't feel like a temporary disruption, they felt like a warning. First came the pandemic, then supply shortages, then inflation shocks, then market swings, then layoffs, headlines, and policy reversals. Each event reinforced the same message: stability can disappear fast. Even when conditions improve, the memory doesn't fade. Households don't reset emotionally when the crisis ends. They carry the lessons forward. And the lesson most people learned was simple. You can be doing everything right and still be one shock away from trouble. This is where psychological anxiety becomes psychological, not mathematical. A household might be employed, bills might be paid, savings might exist, but the question in the background never goes away. What happens if something breaks? Job insecurity plays a major role here. Unemployment rates may be low, but job security feels fragile. Many positions are tied to short-term contracts, volatile industries, or shifting corporate strategies. People don't fear being unemployed forever, they fear the suddenness of it. Because modern job loss doesn't come with a long warning, it comes with an email, a meeting, a locked account. And once you've seen that happen, to yourself or others, it permanently changes how safe employment feels. Debt deepens that vulnerability. Credit cards, auto loans, student loans, they turn small disruptions into serious threats. When households carry balances, there's no room for pause. Missing one paycheck doesn't just mean tightening the budget, it means falling behind. That pressure creates a constant state of alertness. People aren't relaxed, they're managing risk. Even good news gets filtered through that lens. A raise feels nice, but temporary. A bonus feels welcome, but already allocated. Lower inflation feels abstract because the buffer is still missing.
This is why optimism struggles to take hold. Then there's the role of media, not as a villain, but as an amplifier. Economic news cycles move fast. Headlines flip between reassurance and alarm, sometimes within the same week. Markets surge, then sell off. Forecasts change, narratives reverse. For households already on edge, this creates noise, not clarity. People don't know which version of the future to believe. And when uncertainty dominates, the safest emotional position is caution. There's also a deeper issue at work: trust in the system itself. For decades, many Americans believed in a basic economic promise: work hard, stay employed, and life would become gradually more secure. That belief has been shaken, not because it never worked, but because it stopped feeling reliable. Costs outpaced wages, shocks became frequent, safety nets felt thinner, long-term planning became harder. So financial anxiety becomes existential. It's no longer just about next month's bills, it's about whether the future can be planned at all. This explains why sentiment often lags behind reality. Even when data improves, confidence doesn't immediately follow, because confidence isn't built on numbers alone, it's built on predictability, and predictability has been in short supply. When people say they're worried about their financial future, they're not necessarily predicting disaster. They're expressing uncertainty about the rules. Will income keep up? Will costs stay manageable? Will one mistake undo years of effort? Without clear answers, anxiety becomes the rational response. This also changes behavior. Households become conservative. They save when they can. They delay decisions. They avoid commitments. They choose flexibility over growth. From the outside, this can look like pessimism. From the inside, it feels like survival. And here's the critical point. Financial anxiety isn't a sign that people misunderstand the economy. It's a sign that they understand risk very well. They've lived through enough instability to know that improvement doesn't always last, and that recovery doesn't reach everyone equally. So when headlines say things are getting better, people don't reject that message outright. They simply ask a different question: better for how long? And better for whom? Until households feel that progress is durable, not just visible, anxiety will remain. Not because people are irrational, but because trust takes longer to rebuild than it does to break. And that's what makes this moment so important. Economic health isn't just about stabilizing indicators, it's about restoring confidence at the household level. Without that, growth looks good on paper and fragile in real life. Which brings us to the final thought. If financial anxiety is really about trust, stability, and belief in the future, then solving it requires more than better charts. It requires making people feel safe enough to believe again. And that question, how trust is rebuilt, is where this story ultimately leads. So when people say the economy looks fine, they're not necessarily wrong, but they're also not telling the whole story. On paper, the numbers can line up: growth, jobs, cooling inflation, all the signals policymakers and markets look for. But lived experience follows different rules. Households don't feel averages, they feel rent, they feel groceries, they feel insurance premiums, debt payments, and the fear of what happens if income stops, even briefly. That's the paradox at the heart of today's economy. It's not that people are pessimistic, it's that the way we measure economic health doesn't fully capture how fragile life feels on the ground. When progress is uneven, when costs rise faster than security, when stability feels temporary instead of dependable, anxiety isn't irrational, it's adaptive. Understanding this gap matters, because dismissing financial worry as just sentiment misses the warning signal entirely. Economic strength isn't only about charts improving, it's about whether households believe improvement will last and reach them. Until that belief returns, confidence will lag, spending will stay cautious, planning will stay short-term, and the disconnect between headlines and daily life will continue. So here's the real takeaway. If you feel uneasy about money right now, you're not misreading reality, you're responding to it with the information your own life provides. Which brings us to you. How does the economy feel in your own day-to-day life? Do the headlines match your experience or conflict with it? Share your perspective in the comments, because the real state of the economy isn't just in the data, it's in the lives behind the numbers.